We had some big rumblings going on over the weekend in the housing market. So let's talk about the first one, which is the grand plan to fix the housing industry issue for first-time home buyers and to fix affordability, the 50-year mortgage. Yeah, you heard that right. The 50-year mortgage. So we've had the traditional 30-year mortgage since the 30s. It didn't actually become the industry standard until the 60s though. And we have recently seen FHA introducing a 40-year mortgage for those who are recasting or taking their current loan and needing to spread it out longer. But we know we have had a major issue this year with housing affordability. We're at the point now where individuals are having to use over 38% on average of their income to go towards their mortgage, which is the highest it's ever been. And the age of the average first-time homeowner has now risen to 40, which is the highest it's ever been. So we know that affordability is an issue. We have sellers who have really low interest rates that don't necessarily want to sell. It's becoming a tougher market for individuals to buy. So we've hit kind of this rock and a hard place when it comes to affordability, tacking on that interest rates that have not come down yet. So we've been waiting for the government to come up with a good plan, which is like trying to breathe underwater, honestly. So this is the most recent plan that Trump has come up with, which is a 50-year mortgage. So instead of your loan taking you 30 years to pay off, it would take you 50 years to pay off, with the hope that this would lower your payment, which theoretically it would, right? However, there's one little extra caveat there, which is, so when it comes to interest rates and what they cost and what interest rates most people typically lock in at, your 15-year mortgage is actually your lowest interest rates. They tend to be about half a point below the 30-year mark, and that's because it's less risky for the investors, who are truly the ones setting the interest rates, just like certain companies and investors set gas prices. So these investors tend to have better rates for those who are taking out a 15-year mortgage, because they're going to be applying more and more towards the principal faster, so it's less risky for the investor if someone were to foreclose. 30-year tends to again be your standard, so it's about half a point typically above a 15-year. So theoretically, if we had a 50-year mortgage, it could be up to a half a point higher in rate than the 30-year, which cuts into those savings. The other piece of a conventional mortgage is if you're putting less than 20% down, you have mortgage insurance. Mortgage insurance is also derived based off of the term, your loan to value, and your credit. So we could also potentially see 50-year mortgages that have mortgage insurance have higher mortgage insurance costs, because it's a lot riskier for that investor. If someone were to foreclose or have to go into short sale, a lot more money is still owed on that home. It's a lot more that the investor has to potentially cover or lose if the home can't sell for what it's worth. So let's look at this example. This is showing you an average 15 versus an average 30 versus this potential average 50-year mortgage and what that payment would look like. Now I've done 20% down just to make life simple and not have the mortgage insurance equation. But you can see here, if that rate does tend to track with how rates go from these different terms, then that savings that you're getting could be as little as $100 a month. Now, $100 a month is helpful. I'm not saying that it's not. Is it helpful to the point that you feel like you're not suffering with inflation or high mortgages? Probably not. Another piece that you really have to think about if we introduce 50-year mortgages is the amount of interest that is going to be paid. So as it is, even with a 30-year mortgage, you are essentially paying almost the purchase price of your home in interest by the time it's finished, if you were to do a 30-year mortgage. If you do a 50-year mortgage, that actually doubles. So that $400,000 house, you would literally pay over $800,000 in interest. Now, I know what you're gonna say, Ashley, most people don't actually live in their home for 50 years. Okay, so the average home span, let's say we're still at the 7-year mark before most people sell, which is kind of where we are, although that'll potentially grow here pretty soon. But even at the 7-year mark, if we look at the difference in interest, you are going to pay over $15,000 more in interest to save $100 a month. So you're going to save you're going to pay $15,000 more in interest to save $8,400 across 7 years. That's like getting a credit card to have the points for flights, but then you can only book a first class ticket. So it costs you an obscene amount. So it's another one of those wonderful ideas being presented that looks like on paper that it might be helpful, but the real question is, will it be helpful? So if a first-time home buyer's goal is just immediate monthly savings, they're planning on being in a home for a very little amount of time, and $100 puts them in between qualifying and not qualifying, yes, maybe a 50-year mortgage is helpful. However, for the average home buyer that's going to be in their home for 7 years or more, especially as housing prices are growing, many people will likely stay in their homes for longer. A 50-year mortgage may not be quite what you think it is. Now, that also doesn't mean that if we do see a 50-year mortgage, people couldn't refinance and bring that term down to a 30-year, 20-year, maybe we'll have another 40-year thrown in the mix. But I'm going to be honest, I don't think the 50-year is going to come to fruition anyway. I think it's just another thing being thrown out there, but I know there's a lot of media about it this week, probably a lot of questions about it. A lot of people going, well, why wouldn't I just do that? Why not? And a lot of people say the same thing about their car, right? Why wouldn't I just take it out to the full 7-year term? I can make extra payments and pay it off sooner. And that is a great plan if you know that you're going to make extra payments and you're looking to keep that payment lower. However, that doesn't always happen, and then you could end up paying a lot more interest, and the amount of interest you pay on a $400,000 house is significantly more than you might pay on like a $30,000 car. So something to keep in mind. If you have questions though, feel free to reach out. Licensed in North Carolina, South Carolina, and Florida.